Welcome to Investors Insights, where today's topic is underwater. Guys, a lot going on this week. The big news will be the Fed. The Fed meets this week, and while we don't think they will cut rates, it's all about the verbiage. What's the Fed going to say about going forward? Are they going to possibly cut in July? I know this, the market is looking for them to cut maybe this week, but at least by July. And so we're watching that carefully. Trey, talk about that.
Yeah, I think what's very important is, like you said, the verbiage, how the Fed either does or doesn't decide to cut. Because not only are they making a statement about their interest rate policy, they're making a statement about their opinion of the U.S. economy. And so while the market has a 1 in 4 chance that the Fed's going to cut this week on their Wednesday announcement, the next meeting is in July. And so that's not that far down the road. So not a lot in the economy can change. So if they say we're going to cut rates, it looks like likely to cut rates in July. Does that mean the economy is currently in a bad position, or are they looking at international issues? Because also on Thursday, the Bank of Japan and the Bank of England will announce their decisions. So currently, our Fed funds rate is between 2.25 and 2.5%. The Bank of England's current rate is 0.75%, and the Bank of Japan's is negative 0.1. So our Fed has a lot of could come down a good bit before it catches up with its counterparts overseas. So it just shows how much stronger our economy is than the overseas markets. But where's that equilibrium? The market clearly expects the Fed to cut once, if not twice, this year, and it's June. So we're running out of year. And so it kind of depends on how they say they cut and why. Is it because our economy is weak? Markets probably won't like that. Is it because there's weakness overseas? It's a little less, and there's a lot that comes into that. I mean, Adam talked a lot about things that might impact inflation and such.
Yeah, and so obviously it's all about the Fed this week. All eyes are going to be on the Fed. But one thing we talked about last week, and the reason we named the topic video is underwater, is last week you talked about all the crops being damaged and the impact that the weather is having. And we want to continue that discussion because it's a big deal. Talk about that.
Yeah, we talked about last week, corn and soybean production in the U.S. and how that's gone down dramatically because of the weather. There's still millions of acres unseeded in a $51 billion corn market. That's a huge amount. They're expecting the smallest corn harvest in the last 4 years. Now, it could be even longer if technology hasn't evolved to the point where they can grow this quicker. There's forecasts for more rain, so that's not a good thing. Corn prices have gone up, but who's going to benefit? Your farmer can't benefit because they're not putting crops in the ground. So, it's a huge deal, and it rolls over to truckers, carrying the corn. It rolls over to people selling equipment and herbicides. So this is, it is a ripple effect across the country.
You got increased pricing on corn, which is bad because corn is in a lot of things. But then also corn is used to feed animals, beef and pork. All those prices could go up. Corn is now in our fuel, could push fuel prices up. So and like you said, the American farmer, corn producer, isn't getting the benefit of this because prices are going up because they are not growing and selling corn.
Yeah.
And so this could be a net bad, and something the Fed will have to look at. This is inflationary. Can the Fed cut rates in the face of rising inflation?
Right. And it's not done. I mean, you have a hot summer and then an early frost, and that's going to throw even more into the mix.
Yeah. So the question is, can higher prices hurt the consumer? When Ashley, talk about the strong consumer, because the consumer number is really good.
Actually, that's going to make it, to Trey's point, more problematic for the Fed this week because we've been kind of living the last year or two on better manufacturing numbers and housing and all of that. Those have been off a little bit, but the consumer kind of roared back last week with what they did in May, what they did in sort of the first couple of quarters, first full quarter of this year. And not only was retail spending up nicely, it was very broadly based. It was gas stations, it was electronic stores, it was restaurants. So now in terms of the Fed cutting, now where the retail had kind of been on the side and sort of somewhat forgotten a little bit, well, here comes the American consumer again. That's inflationary, potentially, much like the crops are. And so when you look at that, they're going to have to deal with that. Trey and I also were mentioning this morning, as far as the Fed is concerned, this is a lot like 1995. We're not looking at a rate cut because the economy is bad. We're just anticipating a soft landing. That was one of the few times they've executed a soft landing properly.
That's right.
And this looks a lot like that.
If they can pull off 1995 again, I think people remember fondly the years between 1995 and 2000 when the economy did finally turn over. Not a bad time period. So if the Fed can pull this off, where they cut rates not because the economy is doing bad, but cut because they overextended on the upside, I think it'd be very good for market stocks and the overall economy and individuals.
And this consumer could, you could still have a rate cut, but if anything, these consumer numbers may push it off later in the year, maybe even September, somewhere in there.
Yeah.
Yeah, so lots to analyze. We're going to be watching the Fed decision very carefully because that could potentially be a big market mover and how it impacts your portfolio. So watching things carefully. If you have any questions, please call us. A lot going on. We'd love to hear from you. Have a great week. Thanks for watching.